The market capitalization of giants such as Apple is more than twice Russia's GDP, and the capitalization of Nvidia is higher than the combined GDP of countries such as Italy and Spain, and greater than that of France. So what is market capitalization, and why is it important? Let me put it as simply as possible. In short, it is the amount of money you would need to pay to buy all the shares of a company at their current market price and become its sole owner. It is a key indicator of how the market values a company at a given moment and is one of the main criteria for investors. Formally speaking, capitalization equals company price, or as they say, how much the company is worth based on the current share price. If you, as an investor, buy all the shares of a particular company on the stock market, you become its sole owner with 100% voting rights, dividends, and assets. Capitalization is calculated using a simple formula. Number of shares outstanding multiplied by the current price per share. The number of shares outstanding is the total number of shares of a company that are traded on the stock exchange. It is important to understand that only outstanding shares are taken into account when calculating capitalization. Those shares that are already in free circulation on the market. Treasury shares are those shares that are held by the company itself and are not taken into account when calculating capitalization. What affects capitalization? When there is good news about a company or an economic boom is expected in a particular sector of the economy, such as artificial intelligence, the shares of companies associated with high expectations go up, and therefore their capitalization grows. Conversely, if there are rumors of difficulties at a company or problems in the sector as a whole, loss of markets, or anything else such as scandals and management changes, the company's shares fall, along with a decrease in capitalization. For example, in 2022, due to a decline in advertising revenue, Meta's shares plummeted by 70%, which reduced its capitalization by 70% accordingly. Why is capitalization growth important? It is the most obvious indicator of success and market confidence in the company's future. It gives the company a number of strategic, financial, and operational advantages. Investors trust large companies the most, which increases the price of shares and makes it easier to attract new capital. A corporation can issue new shares at a higher price or take out a bank loan at a low interest rate. In addition, shares act as currency for companies, which they can use to pay their employees, use their shares as collateral, or buy other companies without using cash. Why is this indicator needed? The main purpose of capitalization is to determine the size of company. Investors use it to classify companies by size, which makes it easy to compare two companies in the same industry and assess potential risks and returns. And, as mentioned at the beginning, it is an indicator of a company's value, so it serves as a starting point for determining the shareholder value of the acquired company. It shows how much needs to be paid to shareholders to buy the business. But this is only a starting point. When buying a business, more complex formulas are used, taking into account a variety of indicators. It is also important to understand that high capitalization does not equal high company profitability. Capitalization is an indicator of confidence in the company's future. The table shows that some companies have lower capitalization compared to others, while having much higher revenues. Stock exchanges are compared using the same principle. The more companies are listed on, and the higher their share price, the greater the capitalization and prestige of the exchange.